Hey everyone, welcome back to another Behind the Hype. Behind the Hype, if you've joined us before, you'll know we tackle overhyped topics in fintech, break it down, have a bit of a discussion, hopefully a bit of education around a particular topic. Today, we're talking about building a bank with Finastra. So Finastra provides global technology to financial institutions across the world in many different lines of business. So across retail banking, corporate banking, payments, lending, treasury, and capital markets. So we cover quite a broad spectrum of the world of finance. So we're going to break down actually what does that mean in terms of from a bank, what's it made up of? So everything from deposits through to lending, trade finance, and more. We're joined today by Jean-Baptiste, who is our product director and platform lead for treasury and capital markets. He's actually run this session before in French, I believe. This is the first time he's going to be running it, at least to me, in English. So I'm very much looking forward to it. Thank you for joining us. The way it's going to work is Jean-Baptiste is going to present his slides, run through all of his content, and leave some time at the end for Q&A. Please feel free to ask a question via the comments tab at any section, and we'll get to it at the end of the presentation. But without further ado, I'll pass it on to Jean-Baptiste.
Okay, thank you very much. Welcome everyone. I'm very happy to be with you. Hope you are all safe at home. I mean, we are all on the same boat. Very happy to spend this hour together with you. And actually, this presentation, indeed, I did it first in French in our Paris office. And I received a lot of very good feedback, and everybody was telling me, okay, you should do it more largely, you should do it publicly, because we believe that's something interesting. We learn a lot on how banking is working in practice. So that's why I decided to share it with you on this meetup session. Before to go on the actual bank construction, I like just to ask a basic question. I mean, something which sounds obvious, but in reality is quite interesting to kind of understand more in detail. Why building a bank? I mean, it sounds obvious. I mean, banks is everywhere. I mean, and you know, I mean, the famous quote from Bill Gates, who is saying banks is not necessary, is banking, which is absolutely necessary. And indeed, banking plays an absolutely fundamental role in the economy and our society. More precisely, bank has an essential mechanic between the role of the central bank and the corporate and people. By lending money to the corporate, in fact, banks are ensuring there is always the right amount of money circulating on the economy. And by the way, when we see banks are in trouble, as we have seen in this COVID crisis, where banks start to be under pressure, we see that central bank has to jump in to provide liquidity. That's not the normal situation. In a normal situation, banks are playing this role through lending process. Banks are supplying money to the economy to support the economic growth. So how is it working? This mechanic is in fact constituted of some kind of gears. Each of these gears is effectively a balance sheet. And this balance sheet allows, on one side, as a starting point, the central bank to print cash, so the money we have in our pocket. Then this balance sheet mechanic allows commercial banks to write money on their book. It's not the same status, the money which is written on the book of the bank from the cash which is printed by the central bank. And finally, corporate, but also people through mortgage, corporate here are issuing debts. And it is this mechanic we are going to explore more in detail. So let's have a look to the basic principle of these gears, which are, as I said, effectively balance sheets. Starting with corporate. So at a very high level, for people who are have an accounting background, I mean, it will sound kind of obvious. At a very high level on the balance sheet, you have two columns, the asset and the liabilities, and you must make sure that obviously you are balanced between the amount of asset and the amount of liabilities. So on the liability side, at a very high level, I mean, you will have on the top, you will have the equity, so the capital, which is owned by the shareholder, and then you will have the debt. And then for a corporate, typical corporate asset side, you will have all the machine, so the industrial assets, but also you will have cash, which is carried on the bank. So that brings us to the next gear on our mechanic, the bank balance sheet. On the bank balance sheet, you have obviously at liability still equity shareholder, because commercial banks are private institutions most of the case, so they are owned by the public through equity. But you also have, and that's something very interesting, you also have the sight deposits. So actually, the cash which is owned as an asset by corporate and people are on the liability of the bank as sight deposits. And then on the asset of the bank, on the other side, you will have financial assets. So typically all the loans which has been granted by the bank to people or corporates. But you will also have an amount of reserve, which is either in banknotes, typically the amount you have on the DAB, but also an account in the central bank. Any commercial bank will have an account in the central bank where they carry their reserve in cash. So that's where you see there is a structural difference between the money written by the commercial bank, which is sitting on the liability side of the balance sheet as sight deposits, and on the other side, the cash, which is issued by the central bank, either in banknotes or as an account on the central bank balance sheet, which is owned as an asset by the commercial bank. That brings us to the third gear of our mechanic, the central bank, which is having obviously as liability the cash, which has been printed. So either again in banknotes or the cash which is deposited by the commercial bank in the central bank. And on the asset side, you will have the reserve, which is typically composed of gold. That's particularly true in Europe and in the United States. I mean, you all know in the United States, Fort Knox, where the Fed is carrying the reserve of gold of United States, but you have the same in France, in Germany, in Italy, and so on and so forth, plus financial assets. Actually, today, when you look at the balance sheet of central bank, you will easily see that the amount of financial asset is enormous versus the gold reserve. It's coming from the quantitative easing efforts, which has allowed central bank to provide liquidity to the economy by buying asset and issuing printing cash. So you have a very large balance sheet today sitting on the central bank with a huge amount of assets, which can be various type of debts and financial assets. And by the way, with the COVID situation, I mean, the quantitative easing has restarted. So we see the size of the central bank balance sheet growing again. So here it's a very basic mechanic, and then we are going to see much more in detail how it works, focusing on the commercial bank balance sheet. But you see that each of these players, central bank, commercial bank, and corporate, are interacting together through the relationship they have on their balance sheet. It starts with the reserve at the central bank, then the cash on the liability, which is owned by the commercial bank, and then you have the deposit account, which is owned either by corporate or by the public. So having said that as an introduction, I want to kind of explain, I mean, the second concept, which is very important to understand to get the financial system mechanic. As any mechanic, you need oil. And in the financial system, this oil is trust. So you need to make sure to avoid the mechanic to get stopped with rust. You need to ensure there is enough trust between the player. And that's the purpose of financial regulation. So financial regulation is the engine oil of the financial system mechanic. And you will have actually two kinds of regulation. Both of them are very important and very complementary. On one side, you have the accounting principles, which ensure that you can trust the figures which are on the balance sheets of the financial systems. As we have seen, the balance sheets are essential. I mean, it is the gears of the system, so you need to make sure you can trust the figure you see on this balance sheet. And if there is a mistrust here, that means you cannot rely anymore and stop the mechanic. That's one. And the second type of regulation you have is what's called the prudential regulation, which ensure that you can trust there is enough reserve to back the risk. So for the central bank, there is enough gold, for instance, or enough good quality asset on the asset side of the balance sheet. And for commercial bank, you need to trust there is enough capital and enough reserve at the central bank to trust the solidity of your bank. And it is these two pillars of the regulation, accounting on one side, prudential on the other side. So typically accounting is the IFRS type of norms, that the accounting principles, and typically the prudential regulation is the Basel type of norms. Both of them ensure that there is trust between the player of the financial system and the mechanic and the gears can work properly. Okay, so that's what now we are going to build using Finastra system. So why Finastra system? Because Finastra, as introduced earlier, I mean, it's a very large fintech company, and we are supporting a very large number of banks activities from a cash deposit to lending, trade finance, forex, and we are owning, as you can see on those figures, I mean, a substantial part of the financial transaction across these various banking activities. So it's typically very interesting to see how you can bring together the different system we are supporting at Finastra and build a bank. And that's exactly what we are going to do. So now, okay, just imagine that you want to build a bank. You just got your banking license, because as we have seen, I mean, bank is a regulated institution, so you need a license to operate. And on this license, you will promise that you will report what called the financial ratios of your bank. And we are going to see how this is calculated. So let's assume you have your license, you open your bank. So obviously you are going to open a digital bank. And the first thing you need to do is to raise capital. I mean, that by the way is the case for any incorporation, you need to raise capital, but in banking, capital play a very important role. So you are going to raise capital, you are going to raise, let's say, 50 million. I put 50 here, but just keep in mind that, I mean, to be serious, it will be in millions. So $50 million as equity. So you have shareholder, and this money your shareholder is bringing you, you are going to invest it, you are going to buy treasury bills. So treasury bills is a debt issued by the US government. So it's considered as a very highly secured type of asset. So that's typically something you want to buy with the capital money of your shareholder. So that's the first step. At this point, obviously, you are not earning any money. You just have open your balance sheets with a size of 50 million. And now we are going to build step by step, activity by activity. We are going to build the commercial banking gear. We are going to build all the financial activities a bank can do, and we are going to see how it's going to play on the balance sheet of the bank. So let's, now you have your bank open. Let's start to make some advertisement and have your first client. So your first client, your commercial bank, will come in your bank and deposit some money. I mean, that's what's called a sight deposit. So it is the money the client is going to bring you, but obviously the client has a right to withdraw this money at any time. That's why it's called the sight deposit. So it's a normal account. So you have a procedure for that to onboard your client and accept the deposit. It's quite seriously regulated, by the way, and you need to ensure you know your client. That's what's called the KYC. So you need to check it is not, it's not a mafia I mean, so it's a regular client, and you also need to check that the money is not a money laundering money. You need to check it is a clean money. Otherwise, you are not authorized to accept this money as deposit. So assume it's all fine. You accept the deposit, which, as I said at the beginning, comes on the liability side of your bank. So now you have 100 million deposit from your initial clients. With this 100 million, you are going to buy for 50 million additional treasury bills. So now you have 100 million of treasury bills, and the rest you are going to put it on your reserve account in the central bank. So note that this reserve account can be built in two pieces. You can have money on the central bank account, but you can also have cash, so meaning banknotes, in your automatic cash machine. It is exactly equivalent. You can always transform banknote into money in the central bank or vice versa. Then, when you start to do that, I mean, your bank is running, and that means you start to be regulated. And the first thing the regulator will ask you to do is to check and to report your liquidity ratio. I mean, you need to make sure you have enough liquid assets to honor the deposits. You need to make sure that if your client want to withdraw the money, you have enough liquid assets to do the payment. So here we are fine because we have in total 150 million liquid assets, 100 million of treasury bills, which can be easily sold, so it's highly liquid, and obviously 50 million at the central bank account, which is by definition a liquid asset. So we have 150 million of liquid assets versus 100 million of sight deposits. So you have a liquidity ratio of 1.5, which is perfectly okay. So this liquidity ratio is typically what our system FusionRisk is calculated. 1.5, so you are safe. You can continue your activity. As you can notice here, at this point, you are not making any money. You give a service of deposit and the guarantee of the deposit, but you are not making any money. So obviously, to start making money, what you want to do is to lend some money to businesses. So you are going to look at the various opportunities you have and select a corporate which has enough good quality business, enough creditworthiness to lend him money. So assume you are going to do a corporate loan here for 100 million. So what you do is you do the loan. There is an onboarding process for this loan. I mean, there is a lot of regulatory stuff you need to do here, and a lot of stuff you need to check regarding the financials of the corporate. So assume you do all these processes using Finastra system. I mean, we have system for that called Fusion Lending, which manages the entire onboarding process. And as soon as it is done, you are going to give the money to the borrower. So the way you give the money to the borrower is by crediting his account in your bank. That means that on one side, you have a new asset, which is a corporate loan for 100 million. And on the other side, you have an additional 100 million as a new deposit in your liability, which means in total now you have 200 as deposit. And that means you have now a balance sheet size of 250. What you can see here is you have leverage, and that's a very interesting concept. With an initial equity of only 50, you have now a balance sheet of 250 million, and that's an essential capacity of bank to create leverage and basically to increase the size of the monetary mass through the lending activity. And as I said, that's an essential role of banking. Through the lending activity, it is possible to control the mass of money you have on the economy through the leverage. But obviously, the leverage brings risk, and that's the reason why the regulator is asking the bank to report the financial ratio. I mean, it's making sure that there is enough capital to back the level of risk carried by the bank on its assets. And for this, there is two concepts. The first one is called the risk-weighted assets. So with this concept, the regulator can measure the amount of risk which is carried by the assets. And the second type of regulation is what's called the IIRBB, so the interest rate banking book, which measure the risk against the change of interest rates on the loan. So here we have Fusion Risk, our risk engine, which is going to calculate the ratios. So we calculate first the risk-weighted asset for the loan. Because it is a corporate loan, the risk-weighted asset is 100% of the notional, so it's 100 million. And you need to ensure you have a minimum of 8% of capital against the risk-weighted assets. So here you are safe because in total you have 50 million of capital and you need regulatory of 8 million. So you have largely enough capital to do this loan. Similar type of calculation on the interest rate risk. You need to have a minimum of 15% of capital versus a typical standard deviation of the interest rate. Here you are fine because you have 7.5 million, which is above the 7 million risk you are carrying on the rate side. Okay, so that's fine. You have done your loan and you have verified all the regulatory ratios to report it back to the regulator. So the regulator is authorizing you to continue your activity. So it's great because now you have an asset where you are actually going to earn money, because this loan, obviously, there is an interest rate and you are going to earn this interest rate, which means that your business is making money. So let's now continue the journey. And let's assume, because that's, again, something which can happen at any time, let's assume that one of your clients is withdrawing money from your account. Again, that's something which is happening every day. Between banks, there is a lot of payments which are done. At the end of the day, you must net all the payments, and it does not necessarily balance between the bank, and therefore there is a settlement that needs to be done between the bank. In Europe, the mechanic which is doing this net settlement between the bank is called Target 2. That's the mechanic in Europe. So assume for your situation that at the end of the day, you have net 50 million withdraw from your clients in your cash accounts. So obviously you need to honor this withdrawal. That means you need to transfer this money to the other banks. And in order to do that, you are going to use your central bank account. So here you have a problem because you have to basically consume the entire amount of central bank money you are carrying as reserve on your assets, which means obviously when you calculate your reserve requirement ratio, you don't have enough money at the central bank, because typically what the regulator is asking you is to have at least 10% of your deposit amount in cash at the central bank. Now we have 0 in cash at the central bank, so it's obviously below the minimum required of $15. So you have a problem here. Fortunately, it is not a catastrophic problem because you are still carrying other liquid assets. If you remember at the beginning, we calculated the liquidity ratio and we included on the liquidity ratio the notional of treasury bills we are carrying on the assets of the balance sheet. And here we are still carrying 100 million of treasury bills in assets. So we are going to use these liquid assets to bring in central bank money in order to satisfy the central bank reserve requirement ratio. So how to do that? There is 2 options. First option, obviously, is to lend the treasury bills, is to sell, the treasury bills. That's something which is feasible. It's a highly liquid market. It's probably the most liquid market of the world, so you can sell it. But there is another way, which might be smarter, is to put it in repo. So to put it in repo, it means you are going to borrow money to other bank by putting the treasury bill as collateral. So basically as guarantee of your loan. So you take your 100 million treasury bills, you bring in a guarantee to another bank, and in exchange of this guarantee, the other bank is going to grant you a loan, which we call it a repo, for the equivalent amount of 100 million. Or in practice, it might not be exactly 100 million because you have a haircut. The bank may just borrow you, let's say, 90 million. But to keep it simple here, I have assumed that you have a 0% haircut and you have a 100 million loan guaranteed by the T-bill collateral. So that's great because now, obviously, you have a new liability on your balance sheet for 100 million because it's a borrowing you have done from another financial institution, but you have received 100 million in cash you can put in your central bank account, which means now you are safe. You have far enough money in central bank account to cover the amount of side deposit you have on your liability. I mean, you have 100 million in the central bank account versus a minimum required of 10% of 150 million, which is equal to 15 million. So you are now safe. You respect your regulatory ratios, and you can continue your banking activity safely. So what's the next step? Obviously, the next step is to collect coupons. As I said, I mean, you have assets on your balance sheet. You have T-bills and you have corporate loan. These two assets is going to generate some coupons. Nowadays, the coupons are not necessarily very high, because the interest rate is very low, which, by the way, put banks under a massive pressure of profitability. So let's assume on my balance sheet, on your balance sheet, we have T-bills at 2% and a corporate loan at 4%. Which is kind of fair figure before the COVID crisis. And let's assume you have now run 1 year your bank, so you get your first yearly coupon. So what's going to happen here is you have $2 of coupon for the T-bills and $4 for the corporate loans, which first will be accrued. That's the reason why it goes first on the asset through accruing mechanism. So you get 102 on the T-bills, 104 on the corporate loan. And once it gets paid, the accrual is transferring cash. So you receive $2 plus $4 million in cash. You can put on the central bank account, which means now you have $106 million in cash at the central bank. And you have started to make a profit of $6, which goes as any profit of any company in the liability of your bank. That means now, by the way, you don't have anymore only $50 of capital, but you have $56 of capital because the profit and loss pile up on the equity. Obviously, at one point, you may remunerate the shareholder through dividends, which means we reduce this amount. But now, at this point in time, you have $56 million of equity in your bank, thanks to the earning you have got from your two assets. So note, by the way, here you are getting the coupon from your collateral. That's normal. The collateral is just a deposit. This is an asset you have put as deposit in your counterparty, but you are still owner of this asset in the sense that you are still receiving the coupon. So your counterparty, which is carrying your collateral, is paying you back the coupon generated by the T-bills, and that's the kind of mechanic we are managing with our treasury system. So in reality, we are managing thousands of these transactions and calculating all the coupons on a daily basis. Okay, so now let's think about what may be the next step. In bad time, which is unfortunately typically what's happening today, corporates may bankrupt. And when they bankrupt, that means that the bank will not necessarily be paid back of the entire notional of the loan. And because of that, the regulator is asking banks to continuously monitor the credit quality of the assets. And if the bank believes that there is a degradation of the credit worthiness on his portfolio of loan, the regulator asks the bank to book what's called a credit impairment. So that's very important, especially under the under the IFRS 9 regulation in Europe or the CECL regulation in the US. Banks are forced to measure on a continuous basis the credit quality of their loan portfolio and to book credit impairment as soon as the bank believes there is a degradation of the credit worthiness. So the bank cannot wait until the maturity of the loan to book the loss. The bank must book the loss as soon as the bank is aware of a credit issue with his clients. And that's very important because it ensures there is no what's called often a zombie asset in the bank. Typically, there is no loan which in fact are bankrupt, but because they are not mature, they are still considered as an asset by the bank. And by doing that, the regulator is improving the quality of the balance sheet data. I mean, if you remember what I say, the two pillars of the regulation, the first one is accounting. The purpose of the accounting is to ensure that the amount of the balance sheet of the bank is trustable. And to be trustable, you need to avoid zombie loan. And to avoid zombie loan, you need to make sure that you impair the value of the loan as soon as you believe there is a degradation of its value. That's the purpose of the IFRS 9 accounting regulation. And that's what we are doing here. We assume that there is an expected loss of 5% on this book of loan. So we are in the obligation to book a credit impairment of 5 million in order to reflect this expectation on my balance sheet. So that's going to cut by 5 million my balance of corporate loan on the asset side, and that's going to debit my profit and loss account by 5 million. That means now I only have 1 million profit because I earned 6 million of coupon, and now I need to cut it by 5 million. Okay, so that's bad luck, but obviously that's what happened with bank on the large portfolio of loan. You will always have a situation where the credit is degrading, and therefore you need to impair the value of your book. Okay, so that's fine. You still have 1 million earning, and more importantly, you are still satisfying the regulatory requirement regarding the amount of capital you need to carry to back the risk. So let's continue our journey, and let's start to do a slightly more sophisticated stuff. One important role of banks in the economy is not just to lend money, it's also to guarantee transaction. So typically when you have international business with an importer and an exporter, you are often in a situation where the importer and the exporter cannot trust each other. Typically, they don't know each other, so they cannot trust each other. The importer doesn't want to pay the exporter because he's not sure he will receive the goods. And on the other side, the exporter does not want to ship the good because he's not sure it will be paid by the importer. So that's a pity, because a good transaction, on an economic point of view, does not happen because of the lack of trust between the importer and the exporter. And that's where the bank are playing a very important role to bringing guarantee in order to support the transaction. And this guarantee is called a letter of credit. That's typically what we are doing with a Finastra system called trade innovation. So the idea here is the importer is going to applicate for a letter of credit, bringing to the bank, which is to his bank, which is called the issuing bank. Then the issuing bank is going to issue the letter of credit to the advising bank, which is a bank of the exporter. If the advising bank accepts this issuance, is going to bring the guarantee to the exporter. So the idea is this guarantee will say to the exporter, ship the good. As soon as I receive the documentation which prove that the shipment has been received by the importer, so there is a checklist of stuff, I will pay you, whatever happened. So even if the importer is not paying, even if the issuing bank is not paying, I will pay you. I bring you this guarantee. So obviously, because the exporter has a good relationship with his bank, he trusts his bank, he's going to accept the letter of credit, is going to ship the good, and it has a guarantee to be paid. Now the shipment is done, the documents are filled in, the advising bank is paying the exporter, then obviously the advising bank is going to ask the money to the issuing bank, which is going to ask the money to the importer for payment. Notice here that you have a much better trust relationship, because now the only trust you need is between the importer and the exporter and their bank. That's typically an area where in normal condition you have a very high level of trust. I mean, typically we are trusting our banks, that's fine. And then you need some trust between the issuing bank and the advising bank. But because banks are regulated, typically you have a much better level of trust around creditworthiness between banks, even at the international scale, than between people. So this letter of credit mechanism allows to reduce the burden of trust from importer to exporter to issuing bank versus advising bank. So it does not remove completely the risk, but it reduces the risk to a financial institution risk, which is very significantly lower. So, okay, you want to start this business in order to support your client, which are exporting goods, and you want to make sure they can benefit from you of guarantees in order to ship their goods in good condition. So what's going to happen on your balance sheet? As soon as you issue this letter of credit, you will have asset and liability in different currency. I mean, assuming here it is dollar and euro. So it is a transaction between Europe and the US. So on the asset side, you have the letter of credit in dollar. So that the amount you are supposed to receive from the buyer as soon as you receive the goods. So that's an asset because it is a promise to be paid. And on the liability, you have a debt, which is the amount you have promised to pay to the exporter bank as soon as you receive the documents. And obviously, between these two assets and liability, you have a risk. As I said, this risk is a financial institution risk, which is lower than a typical risk. And therefore, the risk-weighted asset is only 50% of the notional. So that means the capital required, calculated by Fusion Risk, is now equal to 8% times 50% times the $60 notional of the letter of credit, which makes 2.4%. $2.4, so there's a mistake. So in total, you need $10 of capital, which is safe because you have still your $51 of capital in your bank. So you can perfectly run this trade finance activity while carrying slightly more risk because, again, you are carrying the risk against the correspondent financial institution. Okay, so that's now a new source of revenue, which is quite interesting for the bank because it's typically a lot of fees you can get from this activity while carrying a quite low level of risk, which consume a quite low level of capital. So it's a good business for you, and you are happy to have a Finastra Fusion Trade to support it. So now let's move forward. There is something you may have seen on this letter of credit is you have a foreign exchange risk because you have one asset in dollar, one liability in euro. So as a bank, you don't want necessarily to carry this risk, and therefore you are going to ask your trading floor. So now we move on the trading book of the bank. You are going to ask your trading floor to buy a forex forward. So typically you are going to buy the reverse transaction, euro-dollar, at the maturity of the letter of credit to ensure you cover your exposure to the forex exchange. So you buy this forex forward. A good thing is you are going to get it at a good price versus the market rate because you have a client who is happy to pay you with a premium. And this trading activity is going to generate a profit of $3, which is generated by the trading book and which goes on as a credit on the P&L of your bank. So I mean that's great because that means your hedging is generating some additional money. Okay, so now we are going to do slightly more complex operation on the trading book. If you remember, we have funded one corporate with a loan. It was a 10-year loan with a fixed rate. But obviously, it's not with a floating rate, sorry. But obviously, it's not necessarily the best situation for a corporate because his revenue is not indexed to the floating rate. Typically, the revenue of a corporate, it depends on this operation, and it can be seen as pretty fixed versus the evolution of the rate on the financial market. And therefore, for the corporate, it's a risk to have revenue as a fixed revenue and the financial charge as a floating rate. And therefore, the corporate is asking you, your client is asking you, is calling you in order to get a swap to secure the financial cost of their loan. So what they want is to swap a fixed rate and receive the floating rate. So that way, the corporate will receive and pay a floating rate, so it will be covered, and the corporate will be in a good situation to pay on a regular basis a fixed rate, thanks to a fixed revenue it gets from its clients. So that's typically what's happening when the bank are doing a loan. There is often a swap which is done on the back of it in order to cover the client from the evolution of the interest rates on the market. So as a bank, you say, okay, sure, I'm going to sign with you what's called an over-the-counter swap, where I'm going to swap a fixed rate 10-year against a floating rate. So you may have heard that there is a big transformation on the market as we speak on the LIBOR, which means that typically those floating rate in the past was indexed on what's called the LIBOR rate. So both the loan and the swap was indexed on the LIBOR rate. And now the market is moving on a new type of rate called the risk-free rate. So I'm going to explain in detail the reason of this change, but it is coming from the fact that the LIBOR was highly manipulable, and there has been some scandal on the LIBOR after the 2008 crisis, and therefore the regulator is asking to now index the loan and the swap on a much more reliable rate because there is much bigger volume of financial transactions. So that's typically the job of the risk-free rate. So in the US dollar, it's called the SOFR rate, which is a daily overnight rate. So here the floating rate we are considering is a SOFR, which is going to daily compound versus a fixed rate for 10 years, so which is fixed for 10 years. Okay, so what does it mean for your balance sheet? You are going to book this swap off balance sheet, and that's typically the way you book it, on your trading book. So we have this interest rate swap for 1 billion. Actually, there is a mistake here. So 1 billion 10 years, SOFR, and a rate of 2.03%. I mean, I say 1K, it's a 1K of 1 million. So that makes 1 billion total. Good thing is because it's a client, you are going to negotiate a rate. The client is going to pay you a premium against the market yield curve. So that means this premium is going to generate an additional 4%, $4 P&L, so $4 profits. Notice, don't go into detail, you will charge as well what's called the CVA, which is the credit premium you need to charge to the corporate in order to cover the credit risk which is carried by the swap, assuming the swap is not collateralized. Okay, but obviously this swap is going to generate some risk, and here you have to calculate on your trading book very carefully the market risk you are carrying. And here you have a regulation, which is a prudential regulation, which has been changed, which is not in the past, which is currently being changed. And the new regulatory framework, which has been defined by the Basel Committee, is called the Fundamental Review of the Trading Book. So it's a new way to calculate the risk on the trading book. But globally speaking, it does not change fundamentally stuff. And what you need typically is to calculate a sort of value at risk. So how this is calculated in a nutshell by our system. So what you need is to model the distribution of the risk factor. So typically here you have a normal distribution, but you can have more complex distribution. And then you need to define the confidence level, which is here 99%, so that's equivalent to 2.5 sigma in the case of the normal distribution. You need to assess the standard deviation of your risk factor. So typically, I looked at on the market today is 1.4% 1 year for the 10-year rate in the United States dollar. Then you have the liquidity horizon. So liquidity horizon is a concept which has been introduced by the fundamental review of the trading book. So you need to make sure that you assign the liquidity horizon of the factor of risk you are considering. So typically for a rate, it is 10 days. So you have here 0.2%, a fraction of a year. There is a square root for technical reason. Let's pass that. Then you have 10-year maturity, and then you have your notional, which is 1K of 1 million. That means in total, you have a value at risk for this swap of $70 million. So as you can see, I mean, this swap activity, which is designed to hedge the risk of your corporate, is bringing a very substantial amount of risk on your balance sheet, which means if you look at my risk system, I am breaching my capital ratio risk. I have 58 million of capital, so 50 million of basic equity plus 4 million of P&L, which is below the 80 million, 10 plus 70 million I need to cover my risk. So that's kind of very normal. On the trading book, I mean, the concept is to trade. So when you have a client which needs a hedge, you are going to do the hedge with the client, but immediately after, you are going to resell it on the market. And that's why it's called trading. That's why you have traders, which are on one side supporting their clients selling some hedge, but on the other side, we are hedging the bank by selling on the other side the risk to the market, so either to asset manager, hedge funds, or other banks which needs the reverse risk. So that's now what you are going to do on your system using a Fusion Summit, which is a very well-known system for rate derivatives. You are going to find another counterparty for the reverse, for the opposite interest rate. You find it just for half of the amount. So it's not 1 billion, it's 500 million, but it's going to be good enough to come back on your regulatory limits, because now the risk is only on 500 million. So which means that the capital requirement for your trading book is only 35 million. If you add on the banking book capital requirement of 10 million coming from the loan and the letter of credit, you need in total 45 million capital, which is below the actual capital you are carrying, which is 60 million. Notice here, because you have found as well a good client on this swap, you have the premium, which ensure an additional 2 million profit for your bank. Here, because you are not doing the swap with a corporate, you are doing it with another financial institution. This swap is going to be cleared. That's a concept which has been introduced by the regulator after the 2008 crisis. I mean, the regulation is called EMIR in Europe and Dodd-Frank in the US. It has imposed to clear the swap between financial institutions. So you have a clearing house, so what's called here the CCP, the Central Clearing House Party, who is going to put in the middle and is going to guarantee the credit of the swap between the two counterparties. Obviously, in exchange of these guarantees, the clearing house is going to ask initial margin and then variation margin. So at the beginning, I'm booking here my initial margin of 1% of the notional of my loan. So I need to transfer $5 million from my central bank account to my account at the CCP to benefit of their guarantee. So okay, so now we are at the end of my banking construction. So as you have seen, I mean, we have been step after step building the balance sheet of the bank, starting with raising capital, then accepting deposits, granting a loan, collecting the earning on the loan and on the assets, booking a credit impairment because of the degradation of a portion of the credit worthiness of the loan, starting a supply chain finance business by issuing letter of credit, hedging my treasury in Forex, servicing my customer by providing a hedging service on their debt, and finally trading this hedge by booking swap on the market and clearing this swap in order to stay on my capital requirements. So it is a step-by-step construction. We have been using only a Finastra system to do that, and it gives you, I think, a pretty good picture of the various activities of the bank and the sophistication you have on a bank balance sheet when you bring it all together. So as a conclusion, I will say it is now your turn, because all the system we have at Finastra, and again, I've been using to build this bank, are now available on our FusionFabric.cloud platform. So what we are doing is we are exposing APIs. Those APIs allows you to access data and processes from our system in order to build app which you can sell to the bank, leveraging the capability of our system. That means you can, as a developer, as a company, as a fintech, you can bring your brick on this engine and support the innovation of the bank while relying on the Finastra infrastructure, which again is operating all the steps we have described of the banking activity. I mean, for us, this platform is very important, and we believe that most of the innovation will not necessarily come from Finastra, it will come from the ecosystem around us. And we see our mission to facilitate the onboarding of fintech by banks through this API, which open our capabilities to the public. So thank you very much for your attention. Now what I suggest is we open to question. I hope you find it interesting. I will be very happy to answer any question you may have on this presentation at any steps of this banking construction. So I open the line for Q&A now. Thank you very much.
Thank you very much for going through all of that. It's been a whistle-stop tour of kind of quite a lot of content in terms of, you know, a bank is a large institution, how it all works. So just a reminder to ask questions, just write them in the comments section. Now they'll pop up and we'll tackle them as they come in. To start off, actually, I just wanted to cover, you know, it's a very special time at the moment with a lot changing with obviously COVID-19. What impact do you think that's going to have within that financial landscape in terms of how's it going to have to change in terms of the way that we manage risks, the way we look at lending, etc.?
I mean, first of all, I like to say, I mean, one thing is, I mean, so far, I mean, I cross my finger is the financial system is still up and running. And I think that's really thanks to the regulator, which has put in place a lot of new regulatory frameworks since 2008. So I think here we are largely benefiting of this regulator effort to secure the banking system. We are also using the lesson learned from 2008. And as you know, the central bank has been very, very rapid to pump liquidity on the system in order to avoid failure of the banking system. So I think that the first thing is the banking system is still up and running, thanks to the regulator and thanks to all the systems which are supporting the bank and ensuring that the bank has been able to do their business and calculate their risk. That's the first point. Then what is going to happen? I think there is two things. I mean, it will be essential that banks start lending back to the corporate and SMEs. I mean, we are going to see now the economy are starting to reopen. We are going to see huge demand for credit. Otherwise, a lot of businesses are going to bankrupt. And it's very important the bank plays a role to assess the quality of the business, to go beyond the crisis and assess the long-term quality of the business in order to lend money. In order to do that, it is absolutely key for the bank to have a solid risk model, because it is a risk model which will make the decision, which will determine if the business is healthy on the long term or not. So banks must pay a lot of attention to their risk model ensuring that they can have a good assessment of the real quality of their client business, which will allow them to support the business, which are safe on the long term. So the risk is a very key. And at Finastra, we are helping our clients to put in place some post-COVID risk scenario to ensure they can model the world as it is now and support the business, which again are healthy on the long term. That's number one. Number two is digitalization. It's clear that we are now all kind of living digital. We are working digital. We are learning digital. We are buying digital, and we are accessing our bank digitally. So the transition from the branches to digital is going to accelerate. The transition to the cloud as well is going to accelerate, and that's something at Finastra we are very committed to do. Again, for the benefit of the economy, because the banking is essential for the economy.
That leads me on very nicely to the next question around where do you see emerging technology helping? So think of letter of credit, for example. There's already talk around how blockchain can help that with the kind of exchanging of goods. What gets you really excited when you think of emerging technology and the fundamental aspects of a bank?
Okay, so typically, there is in the banking world, there is two major new technology which is going to transform the financial system. One is blockchain, you mentioned it, and the other one is artificial intelligence. So let's start with blockchain. In blockchain, we see a number of use cases which are not so much live yet. Still very much in experimentation. It's not easy to put in place, but I think we are progressing at speed. But there is still a lot of work to do. So typically, one use case you mentioned it is on letter of credit. As I said, letter of credit is a complex process where you have a number of documents to check, and that's typically something you can do very efficiently with a blockchain. Another area where blockchain is going to completely transform the business is capital markets. We start to see some tokenization of assets. We start to see some bonds, some loan, but also some real estate, gold, being transferred to a distributed ledger, which will facilitate a lot the settlement process, which will make settlement immediate. Therefore, it will reduce a lot the transaction risk and the transaction costs. It will bring transparency to the process. It will reduce crime because it will offer a much better control on money laundering and stuff like that. So digital assets and transfer of the asset to the distributed ledger is starting. It's a long journey, but that will completely transform the capital market industry. On the other side, you have the artificial intelligence, which is much more mature. So here you see plenty of use cases. For instance, you have chatbots. I mentioned that banks become digital, and obviously now is a very good way to interact with the bank to interact with the chatbot. It works very well, but it's also very helpful for the bank on their risk modeling. And that's typically what we are doing nowadays. We are working with some fintech, again, to help the bank to rebuild their risk model. And we use artificial intelligence, which helps a lot to avoid simplification. The world is not just a Gaussian curve. The world is much more complex than that. And artificial intelligence, because the technology allows to capture unlinear effects, allows you to model the world much more precisely. And again, the more precise you are on your risk modeling, the better assessment you will have on the long-term quality of these businesses, and the better you will have the economy recovering, because banks will safely lend to the good business.
So touching upon what you mentioned earlier in your presentation about, interest rates are low, that has an impact on profitability. I've worked at a bank before. I'm sure many of people viewing are either at banks. Profitability, return on tangible equity is a big thing that's always spoken about at a bank. Where do you kind of see coming out of this crisis things changing maybe? Do you think there's potential for new business lines, big transformation? Where is that transformation?
It's not. The time is not easy for bank. For sure, banks have the support of government and central bank, which keeps them safe. So that's good. But on the other side, the financial context is pretty tough. Indeed, the rate is very low. That means the return on assets is very low. And on the other side, obviously, there will be a lot of bankruptcy and therefore a lot of credit impairment, which will hit their earning and which will hit ultimately their capital amount. So it's not easy in this context where you have lower earning and lower capital to maintain a satisfying level of return on equity. I think there is two things banks can do. One, again, is to have a better risk modeling, which allows to make sure that they do the best of their assets, of their capital. And that's, for instance, the full purpose of our Optimum project at Finastra, where we put in place what's called a smart FTP, which ensures that you can have in real time a reallocation of the capital to the banking businesses to maximize the risk-adjusted return of equity. So that's number one. On the other side, banks must develop a fees-based business. They must develop businesses which do not consume capital. And that's typically what they can do through the platform. Through the platform, you can see the bank not just as a funding engine, but you can see the bank as a cornerstone of a larger ecosystem. For instance, when the bank is doing a mortgage, it's not just lending you money. It is supporting you on your buying process of a new home. And therefore, there is a lot of services you can sell around the mortgage. So the mortgage is going to consume capital, but all the other services you can sell will be fees-based and therefore will not consume capital. So on the RAROC, on the risk-adjusted return on capital, it will be highly beneficial. That's typically what we see with supply chain finance, which is a good business because it does not consume so much capital. But I think banks must be very innovative on building new businesses around their core financing capacity to add new stream of revenue. And I think that's where fintech can help a lot. That's where the Finastra FusionFabric.cloud platform can help a lot, because it ensures that fintech can propose new businesses connected with the financial engine, but bringing additional value to customer to collect additional revenue.
So just my last question before we wrap up. So obviously you've touched on a lot of different concepts in different areas of a bank. If someone wants to go and find out more information, build up a bit more knowledge about a specific area, what are your kind of go-to resources that you would recommend people go to?
Okay, honestly, there is a lot, and I think our generation is so lucky to have so easy access to education. So personally, I mean, and by the way, I mean, this presentation has this origin. I mean, I've been very interested, so I don't remember exactly the name of the professor, but it was a course from, I think it was an MIT, I think it was the MIT, a professor, which is online on YouTube and free, which was talking about the financial system, the banking system, and he had this idea that a bank can be built on paper on the balance sheet. So I learned a lot from this one. I think there is also, on a more professional point of view, a lot of very good documentation which are published by fintech and vendors or by service companies. So at Finastra, we are publishing a number of papers. For instance, we have published a paper on LIBOR transition, which is interesting. But you also have paper from Accenture, so typically a system integrator or accounting firm like EY. They are publishing very good paper on financial regulations. And then you have a paper from a regulatory body like a Bank of International Settlements. The ECB as well is publishing interesting documentation. So honestly, there is plenty of document and information available for free. I mean, on the internet, you can use to deep dive on some topic.
Thank you so much for covering a load of really good content there. It's been a great session. Thank you so much. Just to point out, we've got more sessions happening most weeks. So over the next couple of weeks, we've got another Behind the Hype looking at creating a virtual culture with a fintech who's been doing it for a couple of years. So we've got to share some best practice. Then we've also got our innovation team talking about how they're actually deploying an AI model into development. So please join us for that.
Yeah, I think we also have a feedback form. So I'm very interested by your feedback. So thank you very much in advance for your feedback, comments. I mean, I'm happy to see your suggestion as well on how to improve this presentation moving forward.
Yes, so that will get sent out, and as Jean-Baptiste has already said, we're open to improving these, making them better, hearing what's your thoughts, what do you want to cover next. So thank you for joining us, and see you next time.
Thank you very much. Have a good day and keep safe.